Okay, so the whole point, or one of the main reasons why we are reorganizing the balance sheet is so that we can calculate one of the key value drivers, which is the return on invested capital. And ROIC is equal to NOPLAT divided by invested capital. That's not what I wanted to do. And we'll do a version of ROIC both with and without without goodwill. So invested capital with and without goodwill. Now to smooth out any effects that any major changes in invested capital can have on return, we're going to use what's called the average ROIC. And the average ROIC is the NOPLAT of the current year divided by the average of the previous 2 years invested capital. And I'll fix that. Now, the reasoning here is that okay, the reasoning here is that assets on the balance sheet change in big jumps. We don't, and items on the income statement change in sort of steady growth rates. Right? So revenue sort of grows at a generally steady rate. Costs generally grow at the same steady rate. So our NOPLAT tends to be relatively steady, either growing or shrinking, but it's not usually doing that in big jumps. On the balance sheet side, that's not quite true. In fact, on the balance sheet, we tend to see large jumps because assets are not purchased in small pieces. They're purchased all at once. So we might have bought a new building or a bunch of new machinery, and we did that all at once. That can cause a big jump in our, say, net PP&E, which can cause a big change in our invested capital. And then that can cause our ROIC to jump up and down relevant to that. So what we try to do is smooth that out by taking the average invested capital. So we take 2 years of invested capital and we take the average of those 2 years. That way, if there is any big swings because of big asset purchases or sales, it's somewhat smoothed out in our return calculation. The other thing to notice is that our invested capital, including goodwill, is always lower, and that's because goodwill is additional assets, and that makes our invested capital with goodwill higher than our invested capital without. So our return is always higher if our invested capital is lower, given the same level of NOPLAT. And this is why it might be advantageous for a firm to, say, sell some of its assets and then lease them back. Because if they remove some of the net PP&E, they reduce their invested capital, and in doing so, they shouldn't, as long as they're leasing them back, they're not affecting revenues. They're going to have some additional costs here, but it's probably lower than the maintenance costs on the machinery, and it's probably simply replacing the interest costs with rental expense. So it's probably not affecting NOPLAT too largely. I mean, certainly it might do a little bit, but not as much as it affects invested capital. And so because of that, it's going to increase a firm's ROIC. And this is why we want to try to bring these operating leases, these items that they used to own but now rent, and we're going to put them back on the balance sheet. Right? So that's what this reorganized sheet is. Nowhere on the balance sheet will you find capitalized operating leases except on an analyst's reorganized balance sheet as a way to try and undo what the firm did. To try and make sure that we're getting a more accurate picture of its return. So again, I don't want that. We are calculating NOPLAT here. We want NOPLAT in the current year is equal divided by invested capital. So I'm just going to write IC here, invested capital, the average of invested capital over the past 2 years. So we have invested capital this year. We have plus invested capital and let's say T minus 1. Divided by 2. Okay, so that's the formula we're using. We're taking the average here. Let me see if I can make those subscripts again. There we go. Let's make this a subscript again. There we go. Okay, so that's what we should be looking for. That's our formula. Okay. So you'll see that in the homework again. It'll be asking for the average return on invested capital, and this is what it's talking about. We want to try and smooth out the effect of ROIC, invested capital on ROIC rather. Okay, now in part 2, right, part 2, we are going to forecast the financials and the cash flows. So we're going to project the financial information of the firm into the future, right? So again, imagine that we had 10 years of our consolidated financial statements, and we were up to 2013. What we would be doing is we would be projecting the financial statements for another 10, 15 years, right? So I'd want to predict how the firm is going to change. Now, those predictions are going to be guided by a lot of things, and we're not going to do that here because we have a whole lecture on this, we have a whole nother homework on this, and I have a whole nother recording where we go into more detail on making financial forecasts in Excel. So we will just assume that the next step is where we forecast the financial statements. So we're going to say, okay, I predict that these financial statements change, and we're going to forecast all of these values out into the future. And then we're going to use those forecasts to recalculate NOPLAT, invested capital, and ROIC into the future. So in other words, I am not going to specifically forecast NOPLAT or invested capital, or even I'm not just going to forecast return. Rather, I'm going to forecast all the inputs and then use those forecasted inputs to calculate the outputs. Now, we talk about in the lecture that at some point we will ultimately stop making very specific forecasts. We will stop forecasting these items. So we'll probably only forecast every item here for 5, 6 years. And then we'll start to maybe forecast just these items. And then we will maybe just start to forecast NOPLAT and invested capital. And so we're only going to make even forecast of even that length out into maybe say 10, 15 years total. But that would be the next step. We would be forecasting these items into the future. So then we would have 20 years of data, 20, 25 years of data, 10 years of historical data, and then 15 years of forecasted data, right? So we got a big old sheet in front of us. What we want to do with this then is use all of this forecasted data to calculate what's called free cash flow. And free cash flow is all the money that's left over after the firm has paid all its bills. Let's make this accounting. Okay, so free cash flow is all the money that the firm has left over after it's paid all its costs, its operating costs. It's made any investments into assets or anything that it needs for the future. It has then whatever's left over is the firm's to provide back to its investors. Okay? So what we say is that free cash flow is gross cash flow minus, oh no, I just want to write minus there, gross investment. Okay, so gross cash flow minus gross investment. where gross cash flow is equal to NOPLAT plus depreciation and, let me actually write it out. Depreciation and any amortization that is above the line. So here it's just amortization of capitalized software. Okay. So NOPLAT, depreciation, and amortization of capitalized software. Now we are adding these values back in, and so because they're a negative, I need to subtract this. Right, these values are both entered as listed as negatives, but I actually want to add them. Right, so the formula for gross cash flow is NOPLAT plus depreciation plus this amortization. Now it is not all amortization. Okay, again, this is just the amortization for the intangible assets that have been capitalized, specifically listed on the balance sheet. So just the amortization that is above EBITDA here. If this amortization was not there, we would not have amortization here as this line. It would just be NOPLAT plus depreciation. Okay. And that's our gross cash flow. Now, gross investment is the change in any of the items that we use to calculate invested capital. Right? So all of these items. It is the change in all those items. So what we're trying to understand, investment here, is an action. It says, did I use any of my gross cash flow to invest in any of the assets that are my operating assets? So did I have, right, NOPLAT is my operating profit. Depreciation, is it not? The reason we add depreciation and amortization back is those are not actual cash expenses. So this is the cash, gross cash flow is the cash I have on hand every year from operations, total, after I've made, and remember, NOPLAT is after I've spent all my normal operating expenses and paid my taxes. Okay, so this is the cash I have left over from my operations. Gross investment is, did I make any new investments in the assets that I use to operate the business? So what we're going to do here is we're going to take all of these items, right, and we're going to look at whether they changed from one year to the next. Okay, so I'll just come in here and I'll write it. I'll say we want the decrease or the increase in operating working capital. We want what's called capital expenditures, sometimes referred to as CapEx. This is the change in net PP&E plus depreciation. We want any investment in capitalized operating leases, so any change in capitalized operating leases. We want any investment in capitalized software. So did we make an investment in this software asset that we've capitalized? We want the change in our other assets minus other liabilities. We want any investment in goodwill or acquired intangibles. Did we make any changes there, which would occur if we bought a firm during the year? Goodwill and acquired intangibles. And here again, something that we won't talk about till later, what we call something called the foreign currency translation, which is if we have any gains or losses due to changes in currencies based on the countries where the UPS operates. So UPS operates all over the world. There may be some currency translation effects, and we'll talk about that later. Okay, so to do the change, I need to do 1 year minus the next. Man, all these are messed up. 2012, 2013. Okay, so I'll have to start in 2012. What I'm looking for is the difference in operating working capital between 2012 and 2011. So I come back here. I have the operating capital in 2012 minus the operating capital in 2011. Now, there's something important here that I forgot, which is that a change here, what we're asking for is an investment. So this is a negative change, right? We can see that our operating working capital asset decreased from 2011 to 2012. Okay, so our asset decreased. We made, but what that means is that we made a negative investment. There we go. Okay, right. So I multiplied those both by -1 because there is a decrease, right? So this is not money that I'm spending, right? I am not increasing this asset. I am decreasing the asset. I am generating cash flow by decreasing my operating working capital asset, right? And because of that, my investment here is negative. So instead of spending some of this gross cash flow, I am actually generating some additional cash, right? And so all of the changes here will work like that. Now, capital expenditures is the difference between my net PP&E. Right? Did I make any purchases? And here we see that net PP&E went up, so I did spend some of my cash flow investing in property, plant, and equipment, plus my depreciation expense. Now remember that depreciation is the accounting an accounting measure that tries to compare the cost of my assets with the revenue generated by my assets. So net PP&E in practice actually decreases by the amount of depreciation in every year. So if I made no purchases in fixed assets, my net PP&E would decrease every year by the amount of depreciation until it got to 0. The fact that it increased despite me having depreciation means that I made a purchase that exceeds my depreciation amount by a significant amount. Okay. Now again, these are going to be, now these should be negative amounts. Because this is money that we are spending, right? So we're sort of a little bit, I guess, keeping tradition, accounting tradition. What I'm trying to represent in investment here is money coming in or money going out by my positives and negatives. It's not that it's super important as long as you remember what that looks like. Yeah. Now, the change in my capitalized operating leases, did I make any investment in capitalized operating leases? That's again from here, so 2012 minus 2011. And so we notice that capitalized operating leases shrunk and then increased. So we have the opposite. From 2011 to 2013, we recovered some cash. From 2012 to 2013, we spent some cash. And so we have the flip side here. We have some money coming in, we have some money coming out. Investments in capitalized software. This is going to be the same general formula as our This will be the same general formula as our capital expenditures. We are going to want the difference between our capitalized software in 2011 and 2012. Plus, we are going to add back our amortization. Okay, So just like with PP&E, I added back my depreciation. My amortization should slowly decrease the value of my intangible assets over time. The only reason then that my value of my intangible assets is increasing is because the company is spending more money than that to increase the value, to keep it up, to add value to it. So I am adding back my my amortization. Okay. So I am still spending considerable amount of money investing in my capitalized software over time. Now my change in my other assets is just my change over time. Okay, so my other assets minus other liabilities. My change in goodwill and acquired intangibles. So here is goodwill for 2012 plus acquired intangibles for 2012. I just condensed this into one just to save time. Okay, so I do make some additional investment here. Foreign currency translation is again not something that we will we haven't talked about it yet, so we won't talk about it now. So you'll just have to take my word for it there. Okay. So gross investment then is the sum of all these things. And that's why we got to be really careful to make sure that we get our cash inflows, cash outflows right here, so that we are tracking our gross investment specifically, right? So a negative value here means that I used 1.3 billion of my available 6.7 billion to make investments in my assets that I use to operate the firm. A positive value here would mean that I have sold off more assets than I purchased, and that added to my gross cash flow. My free cash flow is my gross cash flow minus my gross investment. Okay, so we can see that UPS has positive free cash flow. What this means is that the firm is generating more money than it needs. Right? NOPLAT is already after its operating costs. It then makes any needed investment in any of the operating assets that it might have, and it has cash flow left to burn. Considerable amount, $5 billion. Right? This is money that can then be used to return to investors, either to pay off debt or to provide back to equity holders. But the firm has obviously uses for this free cash flow. But a firm that's generating free cash flow is a firm that has a lot of value, right? And so this is sort of the goal. If the firm had negative free cash flow, that its gross investment exceeded its gross cash flow, this would be a firm that was investing so much in its assets that it wasn't generating enough revenue to cover all of that investment. And the negative amount would then have to come from the firm's outside investors. The firm would need to be raising equity or raising new debt in order to pay for all its investments. So this is typically the case for younger firms that are investing a lot. For instance, Amazon had negative free cash flow for 15, 20 years as it invested into its business far more than it made from operating its business. And all of that money came from outside investors, from debt holders, from equity holders, who are providing this cash flow to generate this investment in the hopes that eventually it turns around and becomes a company like UPS that's generating significant free cash flow and can provide some of that cash flow back to its investors, right? That's what you're investing for, to get the return in the future. Okay, so we would calculate free cash flow, again, not just for our historical years, but for all of our predicted years. We would have predicted all this stuff. then we would calculate the changes in our predictions, and we would calculate our free cash flow based on those predictions.